Credit cards did not break in a single quarter. They broke in structure. At first, nothing appears unusual. Transactions still clear in seconds. Rewards points accumulate. Monthly statements arrive on schedule. Limits remain visible. Minimum payments are calculated automatically. The system feels intact. Yet beneath that familiarity, something fundamental has shifted. Credit cards were designed as short-term liquidity tools, a bridge between income cycles. Today, they function as long-term debt instruments embedded deeply within the banking system's balance sheets. This distinction matters. The mechanism that turns everyday credit card usage into a structural signal of banking fragility will be clear, and the reason banks cannot easily conceal that signal will no longer appear mysterious. Credit cards are unsecured lending. Unlike mortgage or auto loans, they are not backed by physical collateral. Their security lies in income expectation and statistical modeling. Banks extend revolving credit based on predicted repayment patterns across millions of users. The risk is distributed, but it is not eliminated. For decades, expanding consumer credit supported economic growth. When wages stagnated, credit filled the gap. When consumption slowed, credit limits increased. As long as delinquency rates remained manageable, the system absorbed the expansion. The contradiction is subtle. Credit cards are marketed as convenience, yet they are structurally dependent on continuous borrowing. Banks do not profit from convenience. They profit from revolving balances. Interest accrues. Fees accumulate. Risk is priced into rates. When balances grow faster than repayment capacity, the structure tightens. Historically, unsecured consumer lending has been one of the earliest stress indicators in financial systems. Before housing collapses or sovereign crises, delinquency rates often rise quietly in consumer credit. This is not because credit cards cause collapse. It is because they reveal it. Household balance sheets are the first point of pressure when debt saturates an economy. When wages fail to keep pace with inflation, when asset prices consume more income, when growth slows, households borrow to maintain stability. The borrowing masks fragility. Until it doesn't. In the early 2000s, American consumers relied heavily on credit expansion. Mortgage refinancing extracted equity. Credit card balances rose steadily. Delinquencies appeared contained. Then housing faltered. The collapse of 2008 is remembered as a mortgage crisis. Yet credit card charge-offs surged soon after. Unsecured debt became unmanageable as unemployment rose. Banks absorbed losses through capital injections and policy support. The system survived, but patterns shifted. After 2008, regulations tightened. Capital buffers increased. Stress testing expanded. Credit scoring models grew more sophisticated. Risk became more measured, but leverage remained. Global household debt continued to rise across advanced economies. Interest rates remained historically low for extended periods, encouraging borrowing. Credit cards proliferated with new incentives and reward structures. Superficially, risk seemed contained. Underneath, dependency deepened. Credit cards represent short-duration exposure for banks. Unlike long-term loans, they can reprice quickly. Interest rates adjust. Limits can be reduced. Accounts can be closed. This flexibility protects institutions. It constrains individuals. When banks anticipate stress, they tighten credit conditions before public awareness spreads. Limits are reduced. Promotional rates disappear. Approval standards harden. The signal is rarely announced broadly. It appears individually, through subtle notifications. Most people interpret this as personal financial adjustment. It is often systemic recalibration. Banks monitor aggregate data continuously. Delinquency trends, utilization rates, income volatility. Algorithms detect stress patterns early. When unsecured debt metrics deteriorate, banks respond quietly to preserve capital. This response is not dramatic. It is procedural. The phrase "credit cards just broke" does not refer to malfunction. It refers to the point at which the revolving credit model can no longer expand safely. Expansion requires confidence in repayment. When repayment capacity weakens structurally, growth imbalances becomes unsustainable. Debt accumulation across economies has reached levels unprecedented relative to output. Corporate leverage, sovereign obligations, household borrowing, each layer interacts with banking stability. Credit cards sit at the intersection of household strain and bank profitability. If defaults rise materially, banks must provision for losses. Provisions reduce capital. Reduced capital limits lending capacity elsewhere. The feedback loop extends outward. During the Asian financial crisis of the late 1990s, household debt burdens amplified currency pressures. Banks exposed to consumer defaults faced compounded strain from exchange rate volatility. In Europe after 2008, peripheral economies experienced credit contraction as banks retrenched. Consumer lending declined sharply in affected regions. Credit conditions tightened before headlines form. Trust erodes first in balance sheets. One quiet indicator is utilization rate, the percentage of available credit used by borrowers. Rising utilization suggests constrained liquidity at the household level. When utilization increases broadly, banks interpret it as stress. They respond accordingly. The public often assumes that credit availability reflects economic health. In reality, credit expansion often precedes vulnerability. Credit cards allow consumption to exceed immediate income. This sustains demand temporarily. But repayment obligations accumulate with compounding interest. When rates rise, the cost of servicing revolving balances increases immediately. Unlike fixed-rate mortgages, credit cards adjust quickly. This sensitivity makes them early transmitters of monetary tightening. When central banks increase rates to combat inflation or manage currency stability, credit card APRs climb rapidly. Household budgets compress. Delinquencies follow. Banks observe this before it becomes widely discussed. They adjust provisioning models. Provisioning signals expectation of loss. When provisions increase, it indicates anticipated deterioration. The system remains operational, but its assumptions shift. The loss of reserve currency dominance compounds this dynamic indirectly. If a dominant currency begins to face diversification pressures, borrowing costs may rise structurally over time. Funding costs for banks increase. Higher funding costs compress margins or are passed to consumers through higher rates. Consumer debt becomes heavier. The shift is incremental, yet it reduces flexibility. Flexibility determines resilience. In Latin America, during repeated debt crises, consumer credit tightened sharply as currencies weakened. Households reliant on revolving debt faced escalating costs. Banks limited exposure to preserve capital. Money was not locked physically. Access to credit contracted. This contraction felt personal. It was systemic. Modern digital banking intensifies monitoring. Real-time analytics track spending patterns and payment behavior. Risk models update continuously. When risk thresholds are crossed, actions follow. Limit reductions. Account reviews. Increased scrutiny. These actions are framed as routine. They often reflect broader recalibration. Banks cannot easily conceal aggregate deterioration because financial statements must reflect charge-offs and provisioning. Earnings reports reveal trends. Analysts scrutinize delinquency data. When unsecured consumer debt weakens broadly, it becomes visible. Visibility does not imply collapse. It implies constraint. The narrative that credit cards broke may sound exaggerated. Structurally, it describes a model reaching saturation. Saturation occurs when additional borrowing no longer stimulates growth sustainably, but instead increases fragility. The United States experienced credit saturation prior to 2008. Japan experienced similar saturation before its prolonged stagnation. In Japan's case, consumer debt burdens weighed on recovery for years. Banks survived, but growth remained subdued. Broken systems do not always implode. They stagnate. Stagnation narrows options gradually. Credit cards function as shock absorbers in modern economies. They smooth consumption across income volatility. When shock absorbers fail, volatility transmits directly. Rising delinquency rates can force banks to curtail credit precisely when households need liquidity most. This timing amplifies downturns. Yet from the bank's perspective, contraction is rational. Capital preservation outweighs expansion during uncertainty. The phrase "banks can't hide this" refers to the transparency of credit metrics. Unlike complex derivatives or off-balance sheet exposures, consumer credit data is reported regularly and scrutinized. When trends deteriorate, they are visible in aggregate form. Visibility influences confidence. Confidence shapes funding conditions. Funding conditions affect lending capacity. The loop tightens. Historically, the collapse of unsecured credit often precedes broader retrenchment. In the Great Depression, consumer installment debt contracted sharply as banks failed. In 2008, credit card lines were reduced across millions of accounts, even before defaults peaked. The system responds preemptively. Preemption feels restrictive. Restrictive credit alters behavior. Consumption slows. Growth weakens. Corporate revenues decline. Corporate debt servicing becomes more difficult. Interconnectedness spreads pressure. Complex financial systems distribute risk widely, but they also distribute fragility. When households struggle with unsecured debt, banks adjust capital buffers. When buffers rise, lending falls. When lending falls, growth decelerates. This deceleration feeds back into household income expectations. Expectations matter. If households anticipate stagnation, they reduce spending further. If banks anticipate defaults, they tighten further. The corridor narrows incrementally. Monetary systems rarely collapse suddenly because interventions interrupt downward spirals. Central banks may ease policy. Governments may stimulate demand. Yet easing can weaken currency value. Currency weakness raises import costs. Import costs pressure household budgets. The adjustment relocates rather than resolves imbalance. Trust erodes before overt crisis emerges. Credit cards breaking structurally signals erosion of household creditworthiness. Household creditworthiness underpins bank profitability. Bank profitability underpins financial stability. Financial stability underpins currency credibility. The chain extends upward. Reserve currency status relies partly on confidence in domestic financial health. If domestic consumer sectors weaken persistently, growth prospects diminish. External investors observe these patterns. Diversification occurs gradually. Diversification increases funding costs marginally. Marginal increases compound over time. This is how structural transitions unfold. Not through abrupt failure. Through cumulative constraint. The modern economy depends on revolving credit more than most recognize. When that mechanism strains, adjustment reverberates widely. The break is not in plastic cards. It is in the assumption of perpetual expansion. Perpetual expansion requires perpetual confidence. Confidence depends on sustainable repayment. Sustainable repayment depends on income growth outpacing debt growth. When that relationship inverts, inevitability forms. Not inevitability of collapse tomorrow. Inevitability of transformation. Banks respond first. They reduce exposure. They increase provisions. They signal caution. The public perceives isolated tightening. Historians later identify the inflection point. In archival records, early warnings of systemic stress often appear in consumer credit statistics. Small increases in delinquency. Gradual tightening of standards. Incremental provisioning, rarely dramatic. Yet persistent. The structure shifts before perception adjusts. Credit cards breaking structurally reflects the saturation of debt. Within an economic system already burdened by leverage at multiple levels. It reflects households reaching limits. It reflects banks recognizing those limits. Recognition precedes reaction. Reaction precedes restriction. Restriction precedes redefinition. Redefinition may involve new credit models, digital currencies, alternative payment systems, or regulatory restructuring. Replacement does not announce itself as failure. It presents as modernization. Money has evolved through similar cycles repeatedly, from metallic standards to paper notes. From fixed exchange regimes to floating currencies, from localized banking to global networks. Each transition followed accumulation of imbalance. Each felt manageable until it wasn't. Consumer credit is often the earliest visible fracture because it sits closest to daily life. When that fracture widens, it cannot be hidden indefinitely. Balance sheets reflect it. Earnings reveal it. Trust absorbs it gradually. The perception that something is broken emerges late. By then, adjustment is already underway. Credit cards did not fail in a single announcement. They reached structural limits within a system saturated by debt. Banks respond rationally. Households adapt reluctantly. Currencies absorb pressure quietly, and the financial architecture tightens without spectacle. Money fails slowly. Credit reveals it early. And by the time the break feels obvious, the transformation has already begun.